Most people would think their banks would give them an umbrella when the sun's shining, only to take it away when it actually starts to rain. Well, that couldn't be further from the truth. Most, actually, if not all businesses need some kind of funding in order to grow, and the funding options are usually there come rain or shine. Now, the options can be a bit daunting, but it's just a question of knowing exactly where to look, whether it be going to Dragon's Den or the High Street. I'm going to have a chat with Stephen Fraser, who's an expert in funding from RSM Bentley Jennison, and hopefully his knowledge on the subject is a bit more consistent than the weather today. Hi, Stephen.
Morning, Mike.
Good to see you. Do you fancy a brew?
Great idea.
I'm trying to get to grips with some of the basic financial principles, and if you could just talk to me as if I would know absolutely nothing. Let's start with one of the most basic, bank loans.
Okay. I think at the outset what I would say is two things. Firstly, the economy has changed and therefore raising funding is very difficult for any business that isn't viable, and viability is the key. The second thing is you can separate funding out broadly into debt and equity, and bank loans fall firmly into the category of debt. Typically what it means is a bank is looking for security, and that might be against the property or it might be against some other form of an asset, and they're looking to see that the business is going to generate sufficient cash flow to be able to service that debt. Recently, the banks have launched something called the Enterprise Finance Guarantee in conjunction with the government, and that's been applied to a lot of smaller businesses where there are loans of up to £1 million available. They can be repaid over periods of up to 10 years. It's quite expensive debt. There's a 2% premium, and typically the banks are charging around 4% over base on that. But were I a business seeking to raise bank funding and looking at a bank loan, I'd be saying, well, okay, is this business viable? Look at it critically. Have I got a good business plan? Am I able to service that debt? And then most significantly, do I have the security so that if something goes wrong, the bank can get its money back?
Okay, as opposed to bank loans themselves, what would be the pros and cons then, say, of taking out an overdraft?
Yeah, if you look at an overdraft tends to be something the banks have increasingly shied away from. And that's because an overdraft takes quite a lot of monitoring, because it's a fixed amount of lending over a short period, typically a shorter period of time. And if the business parameters change, i.e. the business starts to decline, and the overdraft is still in place, the bank could be exposed. So again, a bank is going to look at what sort of security it has available if it puts an overdraft in place. We all know what an overdraft is. It's a short-term lending facility, it's a short-term advance. But the bank's going to be saying, during that short term, is the business going to be able to service that? And at the end of it, are they going to be able to repay that overdraft? And if they can't, is there going to be some sort of protection in place for the bank?
And while we're on the subject of loans, can you talk us through the other debt instruments?
Yeah, sure. The banks have been pretty progressive, and the funders have been pretty progressive, and what they've started to do is to isolate out assets against which they can take security. The first one is asset finance, as it's called, and that can relate to hire purchase or it can relate to lease financing. Now, there are various pros and cons between the types of asset finance that are available. Fundamentally, I think my advice would be to anyone that's looking at raising a package would be to explore several of those options, because there are some capital allowance benefits with certain asset finance. With hire purchase, for example, you'll find that at the end of the 3-year term, if that's the term you're hire purchasing over, you will end up owning the asset. With lease finance, you won't. Now, if at the end of that 3 years you don't want the asset because maybe it's obsolete, leasing might be more appropriate, or if you do, then hire purchase may be the better option. I think what I would be judging all of that on is the impact it has on your cash flow. So, for example, what does it need in terms of a deposit? What's the interest charge and penalty being over that period of time?
So my name's John Exley, and I'm the Managing Director of Linton, and we've used block discounting and asset finance to effectively fund rentals to our customers, which has really helped our cash flow. So we sell lasers and other pieces of capital equipment to the medical aesthetics industry, so like doctors and beauty salons and hospitals. So we found that, particularly a few years ago, we started renting equipment. So we put it in and they would pay us monthly to keep the kit, and they earn the revenue with the lasers by offering treatments like tattoo removal, hair removal, things like that. As that sort of grew and grew and grew, we found effectively we were funding their finance, because we were buying the kit or building it and paying for the parts, putting it in, and then taking the money over a period of time. And you can only do so much of that before suddenly your cash starts to get, you know, diminished because you're funding it all. So we looked at sources of or ways to raise cash that would cover the cost of the equipment we were putting in. So this started by using something called block discounting actually. So block discounting was where we would get a contract signed by somebody for 12-month rent, use that contract with a funder to raise money, and they would pay us effectively for the equipment. We would then pay them back over a 3-year period, but that equipment was then earning us revenue and we were being paid monthly for the equipment. And that just boosted the cash in the bank account for us. And the nice thing with block discounting is that the money's raised against the contract itself and not the equipment, not the asset. So if, for example, we then sold that asset off and we moved it somewhere else, all we had to do was make sure we got a new rental contract coming in, and the block discounting people were happy and they just kept giving us more money against these contracts as and when we got new customers.